After a firm open, markets slip as investors turn cautious ahead of the US CPI print today. Also, capital goods and industrials eke out gains while energy and financials slip.
Infosys and HCL Technologies will be declaring their numbers today. Infosys is likely to post weaker growth than peers, while HCL Tech should have a seasonally strong quarter. Both are unlikely to revise their guidance.
Nykaa slips after nearly 0.5% of its equity changes hands via a block deal. RailTel, on the other hand, gets a boost from a duo of orders, while Nalco slides after analysts turn wary after a sharp run-up in the stock.
Market experts tell CNBC-TV18 that equities is not the most preferred asset class today and valuations remain quite punchy relative to other markets, but all repose faith in the India growth story.
Hello and welcome to Halftime Report. I'm Ekta Batra. With me is Mangalam Malu as well as Sonal Bhutra. Well, it's turning out to be a session where there is definitely a lot of wait and watch. It is sluggish for the markets as we speak. The Bank Nifty, which is basically the financials, are underperforming. You'd have to say it is more of a seesaw that we've seen in the past couple of trading sessions. For today, like I mentioned, wait and watch because of the US inflation data. All eyes on that, and that'll be out later this evening. We'll be reacting to it tomorrow, estimated to come in at around 6.5% for the month of December versus 7.1% on a month-on-month basis. Back home, we also have the India CPI data to reckon with for the month of December, expected to be largely flattish on a month-on-month basis. So a lot of cues on the macro front, not to forget Infosys and HCL Tech.
Hey, Ekta. Hey, Mangalam. Good afternoon. Yes, so basically the IT pack continues to be in focus. Just from the broader markets, I was looking at some chemical names. While the overall texture of the market is on the negative side, some of these chemical names are buzzing in how. We have Naveen Fluorine, which is up 6% in trade. We did see December export numbers for the company improve. And the stock had fallen substantially from the highs as well. So some buying is what we are seeing there. There's GHCL, Deepak Fertilizers. We also have Hikal, which is up around 6% as we speak. So yes, some buying in select pockets, so to say, but overall texture of the market continues to remain weak.
It continues to remain weak and it continues to remain in a wait and watch sort of zone. So let's see where that goes. It's also yo-yoing quite a bit. You know, in yesterday's trading session, it was the Nifty Bank which led or lent some sort of support to the markets. But today, that's the one which is lower and down by almost 0.75%. Let's see whether the IT pack and some data coming in from the US supports us or not. But we have been meandering around this range of 17,800 to around 18,100 on the way up. That range is just narrowing. Let's talk about individual stocks then. That's more likely to be in focus on account of news than just wait and watch. And one of them is Mahindra CIE, buzzing around. And it's a stock that has hit a 52-week high in an otherwise wobbly market. Sonia joins in to tell us why.
In fact, you know, not just a 52-week high today, Mahindra CIE has actually doubled from the lows that we saw in the month of June of around 175. It's had a very strong run-up ever since two things happened. One, it decided to sell its German forgings unit. And two, the company is now focused on the opportunity in the electrification of light vehicles in Europe. Now, that's a big trend that's emerging, the electrification of vehicles in Europe. And Mahindra CIE sees that as a big opportunity over there. The stock also, as I said, surged after the company decided to sell its German forgings operation. Now, if the company looks at selling the entity at about 25 to 30% of EV to sales, then that would fetch them about 500 to 600 crores and in turn reduce their annual capex outflow. And hence, that's the positive that the street is looking at. Now, they're also looking to, you know, sell this German forgings business and invest that money in the EV subsidiary, EV component portfolio through either an organic or an inorganic route. Now, Motilal Oswal put out a note a few days ago where they said that the proposed sale of the German CV forgings operation is a positive development. It will result in a better balance sheet for the company as well. And the company aims to improve its operational, profile. So they're looking to raise their EBITDA margins to over 15% in the near term versus 12% in the calendar year 2021. So lots of positive triggers coming through for Mahindra CIE, and the stock is at a fresh 52-week high.
Okay, all right. Sonia, thank you so much for all those details. So from one buzzing stock to the other one, L&T It is the top Nifty gainer today. It is on the back of a fresh brokerage call as well. We have the details with us as well. So JP Morgan, it has raised the target price to 2,300 rupees per share. It has an overweight rating on the stock as well. So the couple of reasons why they are overweight. The first one is that they think that 2023 will be another year of positive returns with core upside. So the core business where the PE multiple should remain cemented by continued order momentum as well. So the company has been continuously seeing order inflows on the higher levels as well. Results could meet the guidance that they had given in FY23 after 3 years. And in FY24, JP Morgan expects robust mid-teens growth for the company as well. They see potential in both India and Middle Eastern business as well. And additionally, there are large prospects capable of swinging a favorable outcome in general. And they see continued strength in execution that could drive EPS upgrades for the stock going forward as well. There's large book to bill and stable working capital as well, which is working well for L&T, and that's why the stock is up in trade today.
Okay, holding up well in a weak market. That's Larsen and Toubro. Thanks, Sonal, for that. Let's go back to Sonia. CG Power is buzzing. It will be reporting its numbers at the end of this month. But why exactly is it buzzing today? It's at a record high. Sonia joins in with more. Sonia.
So, the stock is at a record high, as you said. Now, CG Power has three main businesses, which is industrial, power and railway. Now, in the industrial segment, CG Power has over 35% market share. And within that, CG Power is looking at the electric vehicle motor space in a big way. So, the EV motors currently is in a developmental stage. But CG Power is making a lot of investments over there. Their focus is on EV motors. In the annual report, they said that EVs are the next big opportunity over the next 4 to 5 years for CG Power. They have a 230 crore capex that they have initially planned in a facility in Goa, where they will be looking to increase their capacity there. And overall, the capex is about 400 crores that they're looking at in the electric vehicle space. Now, also, their earnings have been improving quite a bit. You mentioned that Q3 earnings will be reported on the 24th of Jan. If you look at the first half of the fiscal as well, their EBITDA margins improved 200 basis points to 14.2%. So all eyes will be on the earnings this quarter. Ahead of that, the stock is seeing buying, but the focus on the EV motor segment, which is still at a development stage, but there are big investments being made there. That's the reason I'm tracking the stock today.
Okay, all right, Sonia, thank you so much for that. So CG Power is the stock on our radar. Kalyani Steels is the other stock. Earlier today, we caught up with RK Goel, MD of the company, to discuss the price and demand situation on ground. Let's listen into what he had to say.
As such, we are under tremendous pressure. And Q4, again, we would like to have a price increase. And we have already requested some of the OEs for a price increase. Actually, our cost increase is around 6,000 rupees per metric ton. Now, we are looking for at least for this 6,000 rupees. And that's what we would like OEs to compensate. Now, this 6,000 rupees is basically the cost increase on account of direct raw material price. But whatever cost increase, we would like to get it. And if it is not, if we do not get it, then definitely there is a big impact on our profitability.
All right, that's about Kalyani Steels. But just keep an eye on Navin Fluorine, a big mover from the word go today, and now has extended its gains to the high point of trade, up around 5.5%, the top F&O gainer as we speak. And this at a time when the markets are rather volatile. We have more stocks declining than advancing. The other couple of stocks which are doing well, we have Chola Invests, which is moved to the high point of trade. Info Edge isn't doing particularly badly as well, and some bit of recovery from the lows is what we're seeing on Godrej Properties too from the broader markets. The Nifty sitting with a cut of almost 84 points, holding above that 17,800 mark. But we are getting a flurry of information coming in from Delhi, the Auto Expo, which has kicked off in the capital yesterday after a 3-year hiatus because of COVID. And we saw a lot of launches as well. In fact, this morning itself, we saw 2 new launches from the stable of Maruti, 2 new SUVs coming in, Jimny being one of them as well. And Tata Motors too showcased the Sierra as well as Harrier EV concepts. They also showed the Curvy SUV coupe in near production. In near production avatars. Basically, if you just take a look at the footage that we have from the expo, beautiful pictures out there from the Harrier EV coming in, the other SUV as well as the Curvy. In fact, let's cut across to our colleague Parikshit Luthra, who exclusively spoke to Shailesh Chandra, who's the MD at Tata Motors.
All the products that we have shown here are not just concepts, they are all intended to be launched in the next 2 to 3 year time frame. Avinya, let me start with the one which is the farthest in terms of launch. We are targeting Avinya to come in, say, end of 2025. Harrier is also, you saw it has been now shown as an EV, with quite differentiated exterior looks also. This we intend to bring in 2024. We have the then we have the Sierra. Sierra also comes in 2025. So these are the 3 products that we had showcased, and these are the timelines.
Right. You have said also that Tata Motors will play in different segments, not just in the affordable sub 10 lakh range. So these will be cars which will cater now to the higher end of customers. Is this going to be the next focus for Tata Motors?
We are absolutely following where the market trend is also shifting, and we have seen that within 10 years. 10 years back, the cars were at a median price level of 3.5 to 4 lakh, and then by 2015-16 it became like 5.5, 6 lakh. Today the median price is 9.5 lakh, and it is shifting, towards the right in terms of the price, as far as prices are concerned. So we are just following the trend. There is asked for more and more SUVs, and that is what you see in the portfolio. It is mostly the SUVs that we have launched, and therefore if it is true for ICE, it is true for EVs, that people are more excited about SUV concept. They are looking for bigger cars because there are a lot of customers who are upgrading their current cars. So therefore we are absolutely going in sync with where the growth and sweet spot of the market is going to be.
Right.
That's the approach.
Right. I'd just like to ask you about the Curve Coupe. This is the ICE version that has been unveiled. Last year, you showcased the electric prototype. Give us a sense of the strategy behind this vehicle. When could it hit the markets? Is this a production-ready vehicle?
This is absolutely a production-ready vehicle. In April 2022, we had showcased the EV version, and that was the first Generation 2 EV version that we had displayed. Now, what is Generation 2 EV? Generation 1 EVs, which is the Nexon, Tiago, Tigor, were just replacing the current powertrain. Whatever space was available, we were packing the batteries and the electric powertrain. In Gen 2 vehicle, we are significantly modifying the current architectures to make it more electric ready, in the sense that it can take higher range from 400 km to 550 kilometers, and comes with very sophisticated features that you see in global cars, EV cars and all. So that is the Generation 2. The Generation 2 does therefore both EV as well as ICE, as the Generation 1 cars did. The Gen 3 car will only do EV, which is Avinya. So that's the concept part. Right. We will first bring Curve in EV, and in say a quarter or two, we'll come with the ICE version of that.
Okay, so when can we expect the Curve EV?
It should be in 2024. Hopefully both should come in the year 2024.
Right. CNG, that's a segment that Tata Motors has now started aggressively pursuing. You had the Punch CNG prototype. I won't call it a prototype, it was a production-ready vehicle which has been showcased here. Is this going to hit the market now in the next couple of months?
Yeah, see, one thing I would like to draw the attention, CNG has always been a car with great value proposition in terms of the economics. And that's the reason you see that CNG has been growing at a very fast pace as the network of CNG stations are also increasing. But CNG has always been a very compromised car in terms of performance, features, boot space. Our approach has to take away all these compromises. There should be no car offered to a customer which is always compromised. And therefore Punch and Altra is an expansion of our portfolio from what earlier we had a Tiago and Tigor. And this is going to take away the compromise of boot space. And this is an innovation done by our engineering team. And I would request you to go and see that innovation. We intend to bring it in this year itself.
Right. Also, give us a sense of the growth that you have seen in this fiscal so far, and how do you expect to close FY23?
So this fiscal has been very strong, and I would say that it's been very interesting fiscal, and even calendar year also. If you see the last calendar year, the first half of first quarter of this financial year was supply constrained, and then you started seeing the easing of supplies, industry started supplying 1 million vehicles to the market, and therefore a lot of pent-up demand which was there has got released. This financial year, just like the calendar year 22, is going to hit about 3.8 million units as compared to last financial year, which was at 3.1. It's a massive growth, 25% coming because of the secular growth that in any case PV industry was seeing, but also because of say 3 lakh to 4 lakh of pent-up which was in the system, which has got released. So far what we see, the trend in the market, that bookings are sustaining at certain levels. Of course it is more for certain popular cars, and for rest of the cars, the regular cars, the supply is more than demand. So given the significant growth that we are going to see this year, in this financial year, the base is going to be big, and therefore next year I would expect that it will be just a single digit growth as compared to say 25% growth that we are going to see this financial year.
Okay, so that's the Tata Motors head talking about bookings in fact sustaining, but they will probably see single-digit growth going into FY24 simply because of the high base that they've seen in FY23, with around a 25% growth is what they are estimating at this point in time. GM Breweries also on your screen. It's a profit growth of around 31% that they've clocked this quarter on a year-on-year basis. Margins too have seen a marginal improvement. We'll take a short break, but up next we'll connect with Sandeep Jain, who's the ED of Monte Carlo Fashions, to discuss their Q3 business update. In fact, the company has had a successful winter season with the best ever quarterly sales. We'll be touching base with the management on the other side of this break. Stay put.
Welcome back. Still tuned into Halftime Report on CNBC-TV18. Let's get in the management of Monte Carlo. The company reported its Q3 business update yesterday, and they recorded the best ever quarterly sales in Q3. To know more on the demand situation and business momentum, Sandeep Jain, who is the ED of the company, is joining us now. Sandeep, good afternoon. Thank you so much for joining us. Well, Q3 has been very strong for you, record high sales this time around, and it is a seasonally strong quarter as well. What does Q4 look like, since we are looking at extended winters? And will you be able to meet your guidance? And what about margins? What is the guidance here as far as margins are concerned?
Yeah, very good morning. Yeah, as we witnessed that we have got the best quarterly sales, which crossed 500 crore first time in our history. And as the winter season is progressing, and we have a very severe winter here in northern region and eastern and central region also. So we hope that we are well on track as far as our guidance which we have given in the beginning of the year, that is 20 to 25% growth in this year, and hopefully will sustain our margins too.
Could you give us a sense of how much will spill over in terms of winter wear in sales in the fourth quarter? Because the third quarter we did see some delayed winter.
Yeah, see, EOSS end of sale has started. So normally the fourth quarter is basically it constitutes summer wear as well as winter wear, because the summer supply starts normally in the end of January, and the winter is just ending. The EOSS normally ends in around 15th Feb. So the combination of winter and summer, I would say that winter will contribute around 25-30%. So balance sales will come from the summer wear products.
Okay. Mr. Jain, hi, welcome to the show. You have quite confidently indicated to us that you're going to maintain this 20 to 25% growth in FY23. But what is your outlook in FY24? Do you think that maybe this was probably a one-off year, and this high base that you might have created in terms of growth might result in a lower amount of percentage growth in FY24? Or are you confident and maybe there's a structural change in demand that you're probably foreseeing?
So I think the last year we grew at 40%. So the last year base was very big for us. But on that base, we have given the guidance for 20 to 25%. So I think achieving double-digit growth going forward, I don't think it is difficult. But the only concern we have right now is that the macro situations. So if inflation is controlled by the RBI and the country keeps on growing at 7 to 8% or 7%, what is being indicated by the RBI economic survey also. So I don't think the double-digit growth is it can be achievable.
But sir, double-digit growth could also mean 10 to 15% or 15 to 20%. Give us a sense in terms of whether this kind of momentum that you're seeing in FY23 can be replicated going forward.
See, normally we give our guidance once we have our winter booking, which happens in March. So whenever we have the fourth quarter results, with the fourth quarter results, we give our annual guidance also.
Okay.
So I'm not able to, give you a forward-looking statement for next year guidance unless and until we have fourth year numbers and the winter booking in our hand. So it would be more prudent for me to give the guidance once we have in around 15th of May when we give our annual guidance for the next financial year.
Okay. Of the shift that you were looking at from cotton segment, shifting it to woolen portfolio, what is it currently contributing in terms of your overall revenues? Is that a higher margin product for you? And say by the end of FY23, FY24, what will the woolen segment contribute? Will you see a change in the revenue contribution from all the segments that you're working in?
Yeah, I think it is quite visible. The shifting is happening from woolen to cotton. If you see that, normally Q3 used to contribute around 60% of our revenues, and I think this year it will come down below 50% as far as Q3 revenue is concerned. And it's a gradual change from woolen to cotton as we are making progress in South and West, and also we are opening our EBOs in Central and Eastern region. So the shifting is already happening. And already you have indicated that yes, the margins wise in woolen and cotton, it's almost equal. Even at PBT level, we have little better margins in cotton products as compared to woolens.
All right, final question then, Sandeep, if you could just give us a few numbers. Home textiles, 160 crores is your FY23 revenue target. Will you meet it? That's one. Secondly, margins you had guided for around 20 to 21% for this year. Do you maintain that? And thirdly is ad spends. 2 to 3% of your sales is what you had targeted. Will that increase the next year?
I think all the three statements which we made definitely will be on track to achieve all these three statements. The margin band should be around 20 to 22%, which we have given. And the home textile segment, which we forecasted that we should be near around 160 CR, we are well on track to achieve that. And the thirdly, what was the third point?
Ad spends.
Okay, Mr. Jain, can you hear us?
Yes.
So ad spends, will they be around 2 to 3% is what Manglam asked?
Yeah, it should be around 3% of the sales.
Okay, all right, Mr. Jain, it was a pleasure speaking with you. Thank you so much for joining us. So that's the word coming in from Monte Carlo. For now, we'll slip into a short break. Sudeep Shah of SBI Securities will join in with some trading strategies on the other side. Stay tuned.
Well, down 72 points for the Nifty right now, holding a little over that 17,800 mark. We are off the lows of the day by about 40 odd points, but then again, it has been rather choppy. Today's day is more like yesterday itself. If you just take a look at the data points, yesterday's high on the Nifty was 17,976. Today's high on the Nifty, 17,946. At the same time, the December 2022 low on the Nifty, 17,774. Today's low on the Nifty is 17,781. So we just went within those, lows, within proximity of those lows, and have bounced back a good 40 points from there. The question is where we go from here. On the way up, of course, on the Nifty Bank, we are seeing a fair amount of resistance coming in on the 50-day exponential moving average. Today's high on the Nifty Bank, 42,343. Where is the 50-day exponential moving average? 42,369. So all of these data points just point to one thing, that we are extremely choppy and it's in a bit of a range. So ranges are what, option sellers thoroughly enjoy. Today, it's weekly options expiry as well. So let's see what are the active options. On the way up, 17,900 call. That's the one that should come up for you. That's the one which is also most active in today's trading session. The Nifty 17,900 call has added a fair number of shares in open interest for a premium of almost 12 odd rupees. So telling you that levels upwards of 17,900 would face serious resistance. In fact, with the market being a little over 17,800, we're seeing bears attack the 17,850 mark as well. 17,850 call is also seeing a fair amount of writing. The 17,850 call actually has added around 80 lakh shares in open interest for a premium of 30 rupees. So yesterday's high is something that we'll be watching out for, because 850 plus 30, 17,890 thereabouts is where the resistance is. Where is the support? 17,800 put writers are extremely active. 50 lakh shares added for 25 rupees premium. So 17,775, which is close to the December low and today's low as well, would be an important support. And were we to go lower, we would also see some support coming in closer to that 17,750 mark, which is extremely active. So basically a range-bound trade is what we're expecting, or what the option writers are expecting for expiry today.
Okay, well, that's probably because of the wait and watch ahead of the US inflation data. Thanks, Mangalam, for that. Before we get to Sudeep Shah, who's joining in on the technicals, just want to pull up one particular stock. Gland Pharma should come up for you. That stock, in fact, is at the low point of the day, down around 7-odd%. So a sharp cut which is seen on Gland Pharma. Remember, it's already corrected around 60% from its 52-week high. It's been a rank underperformer. To put it into put it into context, the 52-week high was 3,926 rupees for that particular stock. So you can see the kind of decline that we've seen from the top. Sudeep Shah of SBI Securities joins in on the show to discuss everything technical. Sudeep, hi, welcome to the show. First, your call on the indices.
Yeah, good afternoon. See, what I feel is that the markets are at a very crucial juncture right now, 17,750, 17,800. Now, these are the December lows, and in the last 4 sessions, we have seen them tested 3 times now. So, and the significance of these numbers are because it is a 50% retracement of the entire up move from 16,750 to 1,887 that was on 1st December. So what we feel is that it's kind of a range-bound trading that we are witnessing in the last few days. And if we take out these numbers of 17,750 on the downside, if Nifty breaks and sustains below that, then it could easily slide up to its next key support zone around 17,500 and 17,450. So all in all, 17,750 would be the most crucial number that we have to be cautious about. And on the upside, because of the volatility index moving up to 15.6, 15.7, what we feel is that Nifty now will need to take out 8,000 on the upside for any significant short covering move up to 18,200, 18,250, which is kind of a upper end of the resistance that in the last 15, 20 sessions that we have witnessed.
Okay, so 17,750 on the downside is an important level to watch out for. Sudeep, in a market like this where we are seeing a lot of volatility, what would your individual technical picks be?
Yes, Sonal. So what we feel is that right now amongst all the sectors, we feel capital goods stocks are right now doing a fair bit of action, and a lot of outperformance is being witnessed in names like Siemens, Larsen, ABB. And it's while Nifty is sustaining below its key moving averages, and this sector as well as the stocks from these sectors are right now completely playing as a contra bet here right now. So what we feel is Siemens is our top pick, and Siemens has broken out of its 15-day range of 28.30 and 29.30 kind of zone, and it has moved with volumes in the last 2 to 3 days, and we have seen a significant rise in open interest on the long side. So what we feel is the stock, while it is sustaining above its key moving averages, 50 DEMA, 100 DEMA, and it is also outperforming Nifty. So that is giving us confidence that the uptrend in these names would continue, and we feel that Siemens could move to 3080, 3100 and can be bought with a stop loss of 29.35.
All right, thanks a lot, Sudeep, for joining in and giving us your views on the index as well as individual stocks. With that, we'll step into a short break. But as we do that, here's an important information for you, our viewers. Don't miss out on the 19 must-have stocks for 2023 in your portfolio. Subscribe to Money Control Pro to get the full list of those 19 must-have stocks.
Back, HCL Tech will be reporting its third quarter numbers post-markets today. Rima is here to tell us what to expect from the stock. It is the top gain on the Nifty.
Thanks so much for that. So HCL Tech is higher in trade, but remember that over the last 2 days, HCL Tech stock was under pressure. And should we really be expecting any kind of surprise, considering that the company just in December had given an updated guidance? In terms of numbers, a dollar revenue growth of 3.5%, which will be the highest amongst peers. This will be led by a seasonally strong quarter for the products business. EBIT margins are likely to expand to 18.7%, aided by the rupee depreciation. And margin expansion is a trend that we expect in all the IT companies to play out. The revenue growth plus a margin improvement is likely to drive a 10-11% jump in the company's profitability. As I said, it was just last month on 9th of December when the company in its US Analyst Day had tweaked its guidance, and they had said that growth this year will be at the lower end of their guided range of 13.5% to 14.5%. And this is on the back of higher furloughs in BFSI, in high-tech and in telecom. In that analyst day, they had also reiterated the margin guidance of 18 to 19%. So in a way, we already have a sense because after this was known, analysts have made their estimates in Q3. So the street doesn't expect too much of a positive surprise because the company has already guided towards the expectations. The stock is down 18% in the last 1 year and it trades at about 18.5 times forward multiple, cheaper than the peak levels of 25 times, but higher than the pre-COVID average of 14 times.
All right, Reema, thank you so much for that. So that's HCL Tech in focus. Stock is back to the day's high, and the management of HCL Tech will brief the media in a post-earnings press conference at 6 p.m. later today. So stay tuned to CNBC-TV18 for that. And with that, we'll slip into a short break. But before we do that, here's something that you, our viewers, must take note of. CNBC-TV18 and National Stock Exchange have come together to promote investor awareness through a special campaign, Informed Investor, that empowers you to make the right decisions with your money. Nothing in life is guaranteed, but many investors fall for the guaranteed returns gimmick. A smart investor always avoids investing in such schemes and is aware that they are illegal and must be reported to the exchange. Any investment in such schemes is not eligible for compensation from the exchange. Hence, it is wise to avoid investing with anyone promising guaranteed returns in securities market.
Welcome back. Joining us on the show now is Sandeep Bajoria. He is CEO, Sunwin Group. Mr. Bajoria, hi. Good to have you. You know, finally, a long ask from the industry clearly has been heard by the government. We have seen the TRQs being discontinued for the import of crude soybean oil, but for sunflower oil, it continues. How do you see this differentiation?
Because Manisha ji, we import usually 4 million tons of soybean oil, and TRQ were announced only for 2 million tons. So there was already disproportionate allocation of TRQ in soya, and people were unhappy. Some people got a little more, some people got very less. So there was a little mess up in the soya oil TRQ allocation. While in sun oil, our imports are usually about 2 million to 2.2 million, and TRQ was 2 million. So sun oil allocation from import point of view was okay. But there were again in some cases where some people got lesser than what they deserved. However, that was still manageable because import is 2 million, TRQ was 2 million. While soya import was 4 million, then TRQ was only 2 million. So I think government thought in the end that instead of having a TRQ for one more year, it is better to scrap soya TRQ because again it will create anomalies. So in that light, it was a good decision. The industry also welcomed. It removes the distortion. And TRQs were introduced at the time when oil prices were very high.
Right.
And government especially forgot duty of 5.5% and allowed people to put at zero duty and the tariff rate quota. So now the prices have come down so drastically that you actually don't need all this.
Absolutely.
So I believe it was a very right decision, very timely decision government took.
Okay, you know, this is one of the many decisions that the government has taken. Earlier, we also saw stock limits go off on edible oil and oil seeds as well. So would you say that the government slowly seems to be rolling back what is not required anymore? And is there anything else in the line that you're expecting from here?
Yeah, government has been proactive recently. As you rightly said, they removed the stock limit also, which was again step in right direction because the big bumper rapeseed crop is coming in front of us, which is going to be 12 million tons, which was 2 years back, it was only 8 million tons. So 50% increase in the crop. So that was well done. That will support the farmers to some extent.
Okay.
However, now major problem which industry has and which is there in front of government is the difference between import duty of RBD olein, which is a finished product, and crude palm oil, which is a raw material.
Right.
The duty difference in India is only 8.25%. Like CPO duty is 5.5 and RBD olein duty is 13.75.
Okay.
So 8.25% difference is too less for Indian refiners to sustain because in Indonesia, when they export CPO, which is the raw material, they have a duty which is more than $150. And when they export olein, they have duty only of $85.
Correct.
So they get $67 protection, Indonesian refiners. So out of $67, their cost of production is $42. So they sell finished product cheaper by $25 to raw material.
Absolutely.
When
so
Indian shores it lands, RBD olein, which is like for today, for example, the CPO price is quoted at January shipment about $985,
Okay.
while olein price, which is finished product, is quoted at $960. This is $25 cheaper to the raw material price.
Well, absolutely. That is something
So
that the
for
government.
Indian refiners,
That is
it
something that the
very-
government. I get your point, Mr. Bajoria. That is something that the government will need to clear as well, and that's something that you have been putting out as well. But we really need to stop for a very short break. Do not go anywhere. We will continue this discussion with Mr. Bajoria on the other side. Welcome back. We've talked about government's timely measures and timely rollback of that as well. And one ask that the industry still has, and that is about the duty differential between the refined and the crude palm oil. But Mr. Bajoria, what about the prices? And while we have seen them come back off the highs that we saw in the previous year, how is this quarter now looking to you?
Manisha, this quarter looks pretty reasonable and the range bound. If you really see the crude palm oil, which is quoted about $985 today for January shipment, I think the downside for this is not $930 and upside is about $1,100. So we are pretty much in the range of minus 5 to 7% plus on upside plus 10 to 12%. So pretty reasonable range for any commodity to be in, you know.
Okay.
We see the crude oil volatility, you see how the market is like in a day, it is going 7-8% up and 5% down. To that extent, I think veg oil is much more moderate now. And this is what I see in soybean oil and sunflower oil also, which is trading around about $12.60, $65 soybean oil and $12.80 sunflower oil. So downside for both the oils is $1,200 and upside is about $1,350 for the first quarter of 2023 up to March. So I think consumer is going to have a party. Our imports are pretty strong. 1.5 million imported in December, and January import will be, although lower, maybe 1.1 million.
Okay.
But these are very strong numbers of import. Year to year, calendar year, we imported 14 million tons of veg oil worth about $17 billion. So I think the pipeline is very much plentifully available.
Okay.
And consumer are having oils everywhere and at a reasonable price. You saw the government's action also that they are satisfied that yes, supply of veg oil is very much available. This is one commodity which is probably going to give government a lot of comfort from the consumer and inflation point of view.
Okay.
And I think once the industry demand for increasing duty difference between CPM and olein is taken care of in the budget or maybe up to 31st March when the discussion on the budget starts.
Okay.
This duty difference has to be taken up to from 8.25 to 12.5 to 15%.
Okay.
Then I think it is win-win for all the stakeholders. It will be a holistic solution for farmers, processors, government, and consumers.
Stakeholders, basically. Yeah.
Even from the revenue point of view.
All right. So, I mean, a sigh of relief, clearly, when it comes to edible oil as a sector. Last year was all over the place, topsy-turvy, but this year we've started on a better note. And as Mr. Bajoria assures us that there is some laid-back attitude is what you can look at in sense of edible oil prices, enough availability and affordability both in your side there. With that, it's a wrap on Halftime Report. Thank you so much for joining us. After